Evening. I've been building and investing in private and some public companies for over a quarter of a century. And although I continue to make plenty of mistakes, I have developed a few rules. The first set of points I will make this evening are some words of recommendation that I give to potential angel investors. Now, they won't obviously necessarily agree with the previous speaker, but that makes it more fun. So if you're seeking money from a high net worth individual, consider these issues in the context of your business plan. Firstly, expect subsequent rounds. Usually the first financing is not enough to achieve success. Probably need to be seconded, perhaps further calls for cash. Predicting when these calls come and how much money is needed can be very difficult. And judging as an investor when to follow on and when to walk away often separates the experienced investors from the amateurs. Back teams. Few companies are built by one man or woman alone. I think as an investor you should look for a duo or even a triumvirate who have the breadth of skills to make a project work. Margins matter. Decent gross and net margins are vital. If the business is too low margin, then it will always, in my experience, struggle to deliver real value to shareholders. Own the intellectual property. Be wary of firms that do not own their own brands, patents, copyrights, designs, trademarks, and so forth. If the operation is a franchise or license model, then it is so much harder to control your destiny and the upside will always be more limited. Understanding. If you do not know exactly what the business does and how it makes money or proposes to make money, then avoid it. I never back black box deals involving technical stuff that goes over my head. I like straightforward propositions that can be clearly analysed. Price is not the biggest issue. Do not get obsessed about the valuation placed on the company. If early stage investments do well, then the multiple is likely to be big in any event. And focus instead on things like the quality of management and the overall proposition. Try to add value as an investor. Backers who contribute more than just cash are likely to be preferred to those who offer just capital. So pick investments as an investor where you have experience, and obviously as companies try and find investors who have value added, they will offer greater insight and offer better advice. Expect references. I always take references and do background checks on those in whom I trust savings, and find out from independent sources the truth about track records. There's an extraordinary amount of, shall we say, exaggeration in CVs. Never simply accept what you're told without verification. Limit your exposure. Angel investments should never comprise more than, say, 10% of a normal portfolio of someone's net worth, since it is unquestionably, as was said before, high risk, high reward stuff. And very little likelihood of income on the way. It's all about a capital gain at the end. And similarly, I think venture investments should always be diversified across several companies to spread risk. Skin in the game, absolutely vital. Management must have plenty to lose. Do not back entrepreneurs who have financial resources, yet commit very little to the project. And management, as was said before, we want big salaries and perks, have their priorities all wrong. They should be involved for the prospect of a capital gain, not high pay. Choose obsessives. Winning entrepreneurs tend to possess an all-consuming passion when it comes to their business. Growing a new enterprise is a tough challenge. You do not want people who give up too easily or have too many other interests. Form a partnership. The best investing relationships between capital and entrepreneurs are not a them and us relationship, but a close alignment of interests. These solid partnerships are able to withstand the inevitable setbacks, characterise any young business. Patience is a virtue. Great deals frequently take many years to mature. I've held some of my best investments for 10 years or more. And as an investor in early stage businesses, do not expect sudden windfalls. Usually the flops are the first ones to be revealed. And ultimately enjoy the ride. The objective is to make money, but the journey must be fun too. Finding and supporting smaller enterprises that create jobs and generate wealth is a hugely satisfying pursuit, and angel investors do perform a vital economic function, and therefore, they should be proud of what they do and enjoy the task. Now, next, I want to discuss the general matter of debt and equity. Now, in recent years, investors have relied on a very generous banking market to help fund many deals. That era is clearly over. For debt is a bit like alcohol, very powerful stuff, but deadly if used to excess. During the first few years of this century, business gorged itself on debt and became heavily intoxicated with the stuff, and some companies suffered from acute debt poisoning and went bankrupt, or were sold and broken up. And for many others, the last couple of years have been a drawn-out hangover, gradually recovering from an overindulgence of borrowings. And now a great many firms of all descriptions have to live a reformed, debt-free life. Teetotalers from the demon credit. Now, in the new world of debt abstinence, where funding is scarce, the capital structure of deals actually being carried out has changed beyond recognition for what it used to be. I've found that while many major banks are pretending to be open to new customers, in truth, they're actually shrinking their balance sheets and effectively extending no new lines. So acquisitions that at risk capital, for example, we've been considering in recent times, are being financed with 50% or even 100% equity, transactions that 3 or 4 years ago would have needed just 25% equity. And banks have also massively compressed loan amortization. So instead of lenders offering you, say, a 7-year facility with a bullet repayment at termination, these days, one's quite grateful for a 4-year facility with a quarter of principal repaid each year of the term. And arrangement fees and margins charged by banks have increased vastly. And so lenders have essentially gone from being reckless, profitless lending, as it emerged, to overcautious usury, I'm afraid to say. Some cases. I'm sure not NatWest, of course. Entrepreneurs can no longer rely on financial engineering using debt, be it factoring, leasing, revolving credit, term loans, or whatever have you, to fund their projects. If entrepreneurs want their business to grow, be it buying plant, carrying out mergers, financing working capital, they essentially have to consider seriously shareholding partners. On the bigger side, the vast majority of flotation on the stock market, that's out too, because the IPO market remains largely moribund. So companies are forced more than ever to seek private capital. And yet, I do believe taking on angels or venture capitalists can be a positive move, because I think such partners don't just bring cash, but can bring experience, contacts, credibility. Of course, situations can turn sour, but on average, I think private equity relationships, as a majority, can work, because otherwise the industry wouldn't have grown. Now, one alternative for founders having to dilute their ownership stake is to persuade suppliers to provide credit and cajole customers to pay cash up front. And playing games with working capital like this is not for those who like a quiet or easy life, and it's a pretty precarious method of financing an enterprise. And it can't function in many industrial sectors where customers demand credit, but it is one alternative. And, you know, I think, as was said before, you need to discover the sort of firms that do the sort of deals you want. I mean, at Risk Capital Partners, we like taking minority positions in solid firms, whereas a great many private equity firms only do buyouts and want to only own the majority. You know, now I think a lot of businesses, I think this will be quite a busy year, M&A. I think a lot of businesses are seeing the sort of potential of the sunlit uplands and are thinking that, you know, if we have cash, we can invest in research or stock, people, equipment, take advantage of new orders. And as confidence is gradually returning, I think, you know, a lot of more ambitious entrepreneurs like yourselves, perhaps, will look to satisfy the sort of pent-up demand that exists, I think, in many sectors. So, as I say, I think it could be a lively 12 months. And a lot of those deals or acquisitions that have been deferred, I think, may be put into action because people can no longer wait. And, you know, boards, I am sensing, are sort of pushing the button marked advance, you know, believing in a positive future. You know, there might be a double-dip recession, but with luck, not. And overall, of course, despite the idea that they want patient capital, entrepreneurs as a breed are not themselves patient, of course. And And so I suspect the pace will pick up and there will be a lot more equity involved, more mergers, more equity and pragmatism rather than a great deal of debt. And I think in some ways that's a very